Good morning, everybody. Delighted to be here. Let me get straight into the presentation material, and let me talk about what we understand as the alpha trends. Right? That's a nice sounding thing, but what does it mean to all of us? So the way we've interpreted it, alpha means opportunity, it means value addition, and it means the scope for wealth creation for all of us. And who are the different stakeholders out there? There is, of course, investment managers, there are wealth managers, and then most important, for who we all work, which is the investors, right? So we really need to create alpha for our investors, and then along the way, if it can benefit all of us, that's absolutely wonderful. So while I would focus the bulk of the presentation on spending time on what this means to, let us say, the three classes, which is investors, wealth managers, and asset managers, I'll also very briefly, and we've been given a wonderful perspective both by the earlier two speakers on what's happening globally, but a few things of what we believe to be most relevant from a global perspective, and then some local trends which we believe should be relevant. So with that, let me kick off. What is the definition of alternate assets? Arpita really covered it, so I won't spend much time on it other than to say that out here, typically what is non-traditional, which is long-only equity, conventional debt, and let's say physical property or gold, is really what can be classified as alternate assets. The other way of looking at it too is what is mentioned down there. If you can't find a benchmark for it, it's probably alternative, right? So with that broad thing, and I don't think most of us as practitioners are particularly fussed about the definitions, but we pretty much know what feels and sounds like alternative and what sounds like the conventional, let us say, products, right? So pretty much that's the definition which we'd work with. And in the context to which we're speaking about, what we believe is alternate and what I'd be referring to is really everything which comes under the AIF today, erstwhile VCF funds, gold funds, infrastructure development funds, and the proposed REITs under the REIT guidelines. So that's pretty much what I would be referring to as the universe. This by no means is comprehensive, and I'm sure that there are very many other ways which you may choose to classify this, or any other way you may look to, let's say, look at this. But and I think what's more important, rather than getting particularly fussed about definitions and so on, is to just put at least on the table some thoughts from us about which way we see this industry going, what this means to us, and what I would hope to do at the end of, let's say, this session, maybe try to wind up a little fast. And if there are any questions or thoughts which one wants to share, I'd be really happy to hear them, because by no means do we know everything. Okay, moving on, just a couple of slides on what this means. Now, I am absolutely sure that you can't see those slides up there, but pretty much I think what you need to, the only takeaways which I would like to leave you with is that, like was mentioned by Arpita, that your industry really grew in terms of what's happened in the world. It doubled between 2005 to 2007. It had a fairly rocky period after that, but when you look at the pickup in asset growth, it's been extremely strong. And if you look at a period of 05 to 07, and this data is from a McKinsey study which I have faithfully quoted, is that the industry has grown, the alternate industry globally has grown by a little over 14%, relative to close to 2% of the, let us say, the traditional asset management business. So that's a significantly higher growth. And at this point in time, it accounts for close to, let's say, 16% of the global institutional investment is in alternate assets, and 9% from a retail perspective. So that's pretty much it. And in 2010-11 itself, it crossed the earlier peak of what it was at 2007, the alternate assets. So pretty robust growth, the point which was made earlier too. Other point which was made by both the earlier speakers too was what's happening on the institutional participation. Clearly big institutional participation, and some numbers out there how institutional participation has more than doubled over the last few years, as well as what it's likely to be going forward, which is a fairly robust growth. So clearly institutional investors are liking this part of the business. Now, something again in terms of growth on the retail side, but a few things which of course were mentioned, but I just highlight probably one point, or a couple of points which we really want to leave with you is, why are people gravitating towards this asset class? Partly the focus on absolute returns, because when you look at most alternatives, the focus is less on beating a benchmark. In many cases, there is very little of a benchmark, and more on delivering absolute returns. So when you get that perspective, and in an environment where the last few years have been, let's say, relatively difficult, especially for those who may be sort of benchmarked, more so in the emerging markets, alternate investment tends to make a lot of sense, which is more absolute return focused, right? The other one is, and there's another trend which is out there, and again I'm quoting from this report, which says that there has been a lot more focus on traditional managers using, let us say, the traditional retail platforms, which is mutual funds, etc., to push through alternate assets. And that, as a proportion to some numbers given out there, have grown very, very significantly. Incidentally, last 6-ish years, retail assets grown by 21% in the US in alternatives, and in non-US markets, it's 11%, which is way, way ahead of what's happening in those markets. Okay. Now, the other interesting slide, and that's below, from the perspective of, let us say, most of the practitioners out here, is, and this is a really interesting slide, the last one, and if it's not visible, I think the key messages there are the following. 13% of approximately US assets are accounted for by alternate assets, and but 25% of the revenue is accounted for by this asset class. Now that's obviously an opportunity for all of us. It obviously means investors would only pay us when we earn more for them, okay? And if there's something in it for all of us, which is the wealth managers as well as the investment manager, that's great incentive to do business, right? So that's another very interesting thing. So while one is where the volume is, the other is